Good afternoon. Welcome to Bell Direct's weekly wrap. I'm Jessica Amir, a market analyst with the firm. Well, the Aussie share market had another positive week, but we didn't see fireworks, rising 0.6% from Monday right through to Thursday, being largely held back by a Trump-esque tweet from a WiseTech short seller, a sell put on by Afterpay Touch by UBS, and weaker than expected earnings in the TV and radio business, Southern Cross Media hitting their share price. All in all, we're now about 2.9% away from all-time high territory. Over on Wall Street, the picture seemed more rosy. The tech-heavy Nasdaq was up 1.3%, the broader S&P 500 up 1.1%, and the Dow, you can see just under that in orange, gained 0.8%. And even though on the trading week we are not signed, sealed and delivered, but you can really start to see the divergence between us and the US, as in we initially outperformed, and you can see the spike in terms of gains, and then our market fell away. So what's behind the charts? Well, we've seen the healthcare inject a lot of steam and love into the markets. The healthcare sector up the most, 2.8%, with CSL continuing to hit another all-time high. Consumer staples added 1.6%. Industrials followed by financials. Well, energy also added some gains, but they did rise the least. The tech sector and materials or miners, whatever you want to call it, they fell into the red. So what's behind that? We'll get to that in just a sec. But let's pause as to what could outperform going forward and what is the most resilient, not looking at this week. Well, Goldman Sachs says it's skincare and sporting goods as they grew 40% year on year, and goods and furniture are steadily recovering while dairy and alcohol are growing steadily. But if you do have a look at what's the most divergent, well, that's the beauty products. Year on year, they're boding the best. But in terms of the best and worst for this week, the winners and losers, let's dive into those. Aerial imaging company Nearmap shares, they jumped 14% on the back of no news. So it simply reminded investors to take advantage of that massive market opening that they have, and they're continuing to grow their customer base. Financial services company IOOF, their shares are continuing to bounce off last year's lows. This week, they're up 11% after they received 2 of the 3 needed approvals in order to buy ANZ's P&I business. And IFL also sweetened the deal to their favour, dropping the purchase price down to $825 million. That was slashing the purchase price from $950 million. It's a sell stock for Bell Potter, though, with a price target of $3.94 because of the market conditions. It's already around $7.30. And year to date, its shares are up 42%. Meantime, annuity giant Challenger, their shares rose 9% this week after reporting first quarter earnings, with funds under management growing more than expected. It also shows that the market is moving with its feet and hunting for guaranteed income streams or to pay pensions. This year, or year to date, their shares are down 18%. Goldman Sachs and Bell Potter both have the stock as a sell, as its retail sales aren't as strong as hoped. Moving to the worst performers, as we can see, a lot of tech selling occurred this week. WiseTech Global shares lost 12% of its gains this week, leaving it with a year-to-date gain of 77% after JC Capital said the $10 billion firm had fake profits and fake revenues. That sounds very Trump-esque, don't you think? That really spooked markets, wiping off $1 billion of the company's value or market capitalization after they fell 10% or by $3 to $30. And the company did also put out a disclaimer, even though they say that they overstated their revenues by about 180%. Their disclaimer is that they only make profits when the stock declines. We're now awaiting WiseTech's response So let's wait and see what they do say. Citi gave the stock a price target of $36.30. Morgan Stanley says fair value is 29. Macquarie is under that at 28. And Bell Potter downgraded WiseTech Global recently to $25. That's their price target, saying the stock is a sell as growth is already priced into the market. And UBS went against the grain, giving Afterpay Touch a sell target, saying three things. One is that they will come under regulatory scrutiny, and two, that a lot of their gains are priced into the market, and three, that they have a lot of competition. 11% of its gains were wiped off, leaving with a year-to-date gain of about 140% after the buy now, pay later giant continues to grow. Southern Cross, another worst performer, the hardest hit this week, in fact, with their shares falling off a cliff on the day that they reported lackluster results. As we mentioned earlier, the media and markets revenue fell 9% on the prior year. And this week it's lost the most, 25%. Morningstar says there's plenty of room to grow though when things do level off and recover. And there's plenty of upside in the TV and radio market, and that will be significant once it's cleared the decks. Clinuvel Pharmaceuticals shares hit an all-time high last week. This week, another story. Last week, they hit an all-time high after getting the green light from the US FDA to treat rare light exposure to skin disorder patients. But this week, they announced that their chairman will retire. We also saw profit taking on the table after their shares have had an exceptional run. They're up 77% year to date. And that's it. Plenty to absorb. Do have a great weekend, and I'll see you for the market wrap.